All right, so I wanted to go over my trades for the week ending June 18. So I only had 3 trades that I closed. All of them I closed on June 14. So it wasn't a big week. Total for the week was 186 US closed. But I want to go over what I could have actually closed these trades for, and actually some trades that I missed out on this week that I could have easily made. And the whole point of this is just to see and discover opportunities and see how possible this is to generate income by selling options. It doesn't have to, just because a trade wasn't taken doesn't mean that you don't have the ability to take it. All right, so first trade here that I closed was a Teledoc put spread. So I opened April 29 a put spread on Teledoc at a 150-145 strike with June 18 expiry. And if we go look at the chart here on Teledoc, it's interesting because it was completely breached. Teledoc, this put spread was completely breached at some point. So TDOC, if we go back a month, April 29th, we're going to have to go back 6 months. So April 29th, I opened this trade around here, and I opened for the 150, 145 strike, and then Teledoc actually dropped all the way down to 132. So my put spread was completely breached at 150, but I didn't do anything. I held on to it knowing that I still have until June 18, and look what happens at June 18. Stock eventually comes back up, trading between 145, 150, 152, and then eventually on June 18 it closed at 156. So see, I closed it for 40 cents June 13 when I saw it at around 158. Didn't want to take the chances because it was pretty close to my short strike. It was pretty close. So when I saw that I can close it for a profit, it gave me after commission a profit of $47 US. But if I had done nothing and it expired worthless, then it would have been a $93 profit. So that's what I mean, that opportunities are there. It's important to find them and just realize that they exist. But whether you took them or not, I guess it doesn't really matter. But knowing that you are capable of doing it, I think that's more powerful. So that's Teledoc. And then Pinterest over here. Remember, this was a naked put that I'd done for earnings. I think I'd done a 70 strike. I had to roll it down, and I had to roll it a few times. And then I was finally able to close it this week for $2.50. So it was open April 27th. I closed it June 14. It had a July 16 expiry. Net profit of $53. Now let's look at now this option here that I closed for $2.50. It was yesterday on Friday, June 18. It was trading for about $1.40 almost. So let's say I had held on to it when it was trading at $1.40. That's a profit of $1.63. But instead I closed it for $2.50. Well, the reason I closed it because my initial entry was a $1 profit from earnings, but it didn't go my way. So my goal was just to really sort of bring it back. I didn't like my entry when I think Pinterest was trading below 60 at some point. So for me, being able to recover and make a small profit out of it was good enough, given the fact that it wasn't even a good entry to begin with, or that it was completely breached after earnings. So that's why I just wanted to get out of the trade, because I still have a lot of trades open, so I don't want to have way too many trades if something bad happens. So because it wasn't the best entry, for me it was more important to just get out of the trade and recover. Twitter, same thing, same situation as Pinterest. It was an earnings trade, naked put, that got completely breached. I rolled it a few times. So this one had a total credit of $2.17. I closed it for $1.20, which gave me a net profit of $85. Now this one I think is trading for the same thing right now. So I don't regret closing this one at $1.20. Only these two were closed a bit too early. And another one here actually. So this one was from last week. This put spread on Now, I had a 470 short strike. I collected $2. I closed it last week on June 10th for $1.24. But it had a June 18 expiry. And if we go look up Now, you're gonna laugh at this. So this stock was completely breached for me, and it was trading at some point below 4. At some point it was trading below 450. But yeah, look at this crazy jump. It came back up and rallied and closed on June 18. It closed at 533. So this one, if I had just, instead of closing it June 10th, if I had just held to the expiry of June 18, I would have closed this one for $0. It would have given me a $193 profit that would have gone in this week. So it would have made this week a little bit higher, and it would have made the previous week a little bit lower. But yeah, so instead, another one that I closed too early. But given the situation that it was completely breached at some point, I didn't feel like waiting till expiry and seeing what would happen if it drops again. It would be harder to manage. So I closed it back then for $1.24. So another trade that I missed out on this week was Adobe earnings. So Adobe was trading before earnings was being announced, it was trading at around $5.50. And if you watch my previous videos, you know I always do a put spread, either a naked put or a put spread. But at this price here, I was going to do a put spread. I didn't because the stock rallied on the day of earnings, so I wasn't confident in the entry that I would take. It actually started the day at around, it went as low as 5.30, and then it closed the day at around, I think, 5.50. So it bothered me that if I would do a put spread, I would do it after the stock had gone up almost 15 points. So I wasn't confident in the entry, but if I had done it anyways, the stock went up even higher after earnings. So I would have made a profit on that one, would have been a $1 profit. So there's another missed opportunity there. So that's an extra $100 that could have been added here, plus better profits on these two trades as well. Also, on Wednesday during the Fed meeting, I was going to put a put spread on the Qs for 80 cents. The next day was trading for 40 cents. So it would have been a 50% profit in one day. I didn't take the trade, but I was thinking about it. Right over here, I was going to enter a trade for 80 cents. I think it was a put spread at around 335, I believe. I think it's in my trade alert group. But yeah, I didn't take it. But there's another opportunity. Would have been, if I had done two contracts, would have been probably a $70 net profit on that one. So here's what I have left. I have this SPY put spread that I opened June 18 for July 16 expiry. So it's good. Everything I have remaining is July 16 expiry. I've got August 20th expiries. I've got October, November, and December. So the December ones are obviously ones that I'm trying to save that have gone really bad. November as well. October, same thing. So August and July, let's look at them. So this is brand new. I opened it. It actually got filled after hours on Friday, when SPY took a nice drop after hours. It closed, I think, at like 4:14, 4:15, but then after hours went all the way down to 4:13. So it got filled after hours for me, because options on SPY or ETFs that track the index like SPY, Q, triple Q, or DIA or IWM, you can trade the options on them until 4:15 Eastern time. So you have 15 minutes extra after the market closes to trade these types of options. So the order got filled at around 4:02, and it was for the 4:02 397 put spread for July 16. I collected 80 cents. So for me to win on this trade, I just need SPY to stay above 4:02, and that's the profit there. And that's part of the Monday, Wednesday, Friday put spreads that I like to open on the SPY. I haven't been doing them just because the market is at all-time high, so that I don't want to do a put spread when the market is at all-time highs. Plus, it's not a high, doesn't have high premiums. But Friday VIX was high and SPY took a good drop, while everything else didn't. So I felt like it would be a good entry for a put spread. So that's why I entered this trade. Plus, it was a little bit exaggerated, so it only got filled when the SPY dropped even more after hours. Then I've got a covered call here on Luminar, which is okay. It's a bit profitable. It's doing okay. I've got a covered call on Rocket, which is doing well as well. Not closable, but doing well. This one, covered call on Bitcoin, is showing almost a $100 profit, but I'm not going to close it yet. This one's doing pretty bad. This one's just one I'm trying to wait for the stock to recover above either 12.5. 12.5 would be my cost. I wouldn't make any profit from there, but yeah, if I can close it for a scratch, I'll take this one, because I've been holding it for too long, since February 10th. Spotify, so this was another earning trade that went against me, just like Pinterest and Twitter here, but I was able to close Pinterest and Twitter. Spotify I still have. It's not closable yet, but it is on the right track. It's recovering. I've got a 250 strike, so I need Spotify to be above 250 by July 16. So we've got 30 days to go. I think it's trading in the 240s right now. I've got this naked put on AI. At some point, this put option was trading over $4, but It closed the week, I think, at around $2.65. So it's doing better. Not closable yet, but yeah, it's a naked put. If anything, I'll just roll it. This one is doing bad as well, just like SNPR here. So this is just a bad trade that I had. See, as you can see, it was since February 4th. This one I opened yesterday, June 18th. So this is a brand new trade on Corsair. I did a covered call, 30 strike for August 20th expiry. Net cost is $27.75. So it's like selling a put at a 30 strike where I collected $2.25. So as long as Corsair stays above 30, I'll make a profit of $2.25 on this trade. If not, then I'll just sell another call at a 30 strike, regardless what I can collect from the 30 strike, probably $1. It depends where Corsair is trading at. Then I've got HIMS here, a covered call that I just rolled because HIMS dropped below 12.5, which was my strike. So I still own the shares. So I just sold another call and I collected 90 cents by rolling it to August. I have a new trade that I opened June 16 on Roblox, covered call at a 60 strike where I paid 58. So this is similar to selling a put at a 60 strike, collecting $2. But I did it in my registered account because Roblox, I think, has a 50% or 60% margin requirement. So I didn't want to use my margin or TFSA. So I did it in my RSP. And then Etsy. So this is if you remember, I had a put spread on Etsy that expired June 18. So it expired Friday, June 18. I had a 180, 175 put spread on Etsy. And let's go see where Etsy is at right now. So I had a 185, 175 put spread. So I needed Etsy to be above 180 by June 18. It's not. It's at 170. So if I didn't do anything, I would get a max loss of $5 minus the credit received. My put spread initially, so if I click here, I wrote my put spread initially, I had a total credit of $1.15. So if I just let it expire, I would lose about $3.85. But instead of losing that, I decided to roll it, but I rolled it as a naked put. So it went from a put spread to a naked put. So I went from 185, 175 put spread to a naked put of 150 all the way to August. And I collected a credit by rolling of $1.45. So now my total credit is $2.60 on a 150 strike by August 20th. So my break even is 150 minus 260, so it's around 147.4. That's my break even on Etsy. Etsy right now is trading above 169. I just needed to stay above 150 by August. That's all I need for me to win on this trade. Now it is taking a lot of buying power out of me because it's a 50% margin requirement stock with Questrade. So it's taking about $7,000 of maintenance excess from me. So it's a bit high for me for one trade, but I felt like it was the easiest way to manage the breached put spread. And that's the thing I've been doing different. Actually, if I go to my P&L, you can see that in September, October, I had pretty low months, and even September I had losing months. I had a week in September where I lost over $1,100. And what I was doing different, or what I'm doing different now is, or what I was doing different is I was closing my put spreads. If they were losers, I wasn't trying to save them. I wasn't trying to roll them and save them. I would just take the loss, but I would sell a call spread against them before taking a loss to minimize my max loss. But basically, I was accepting the loss and moving on and placing new trades. But then in November, after the elections, I started rolling my put spreads. I started trying to save my put spreads, giving them more time for the stock to come back up if they're ever breached, instead of selling a call spread against them. And as you could see, it definitely made a big difference in trying to save a put spread instead of accepting the loss. Now it helps because the market is in an uptrend, so the stock that I was selling or using ended up coming back up and recovering. But in this case, it did make a difference for me because rolling them just gave me more time for the stock to recover, and therefore I didn't have to confirm a loss. So that's what I'm doing here with Etsy. I'm just rolling it so I don't have to confirm a loss of $300. Rolling it, hopefully it becomes a profitable trade. I might now I can try to close this put for $2 or anything less than $2. Or maybe even try to hold to expiry and collect the full $2.60. We'll see. But because it's taking a lot of buying power out of me, I might close it even for break even. Who knows? But if I close it for break even, I'm basically saving the trade that I had. Instead of losing $385, I lose nothing. I win nothing, I lose nothing, but I basically saved the put spread and I avoided confirming a max loss. Now, maybe you might think it's not capital efficient because it's using 7,000 that I could use somewhere else to make trades. It doesn't matter because I rarely use all my maintenance excess anyway. So even if this I didn't have this trade, it's not like I was going to go ahead and do another trade because this trade didn't exist. I never try to go above 50% of my available buying power anyways. So that capital was available anyways, and I keep it that way so that I can manage the trades that are going bad. So I'd rather have available buying power to manage trades as opposed to confirming loss. I'm not sure if that's the best approach, but that's what I'm comfortable with. Some people say it might be better to use all your buying power or 80% of your buying power to make as much profit when things go well, but then when things go bad, well, then you just take the loss. But because you're using 80% of your buying power most of the time, you're generating good profits. And even if you have to lose sometimes, then overall you're still making more profit. But I find it might be a bit more stressful in my opinion. So you just have to go with what's comfortable. I'm not sure there's one right approach, but it's definitely worth questioning. And then everything else here are just bad trades that I'm trying to save. So nothing great to mention about them. But yeah, these are just trades that I've rolled so far, just trying to save them or waiting for them to recover basically. So these are my trades. So these were my closed trades for the week, and these are my remaining trades. I've got about 21 open trades, so it's not bad. I used to be at 36, so 21 is better than 36. And my P&L for June now. I think we still have 1 week to go to June. 1 week and a few days. So P&L for June is about $20.87 US. So better than May, better than April. So that's good. I don't think it's going to reach March or January, but maybe let's see if I can beat February. Now, next week, I think earnings, we have FedEx and Nike, but Nike premiums aren't great. Let's look up Nike here. Nike, I was thinking about selling the 124 for June, next week's expiry, so June 25th expiry, but the premiums aren't high on Nike. So if we look at the put options, the 124, I could probably sell the 122 for $1 for next week expiry. Actually, this is June 18. It says June 18, but it should be June 25th. I think it's June 25th, Oh, this is the last trade. Sorry. So 122, June 25th expiry, I can get $1. So this could be a potential trade. It'll be about 6 points away, and hoping that Nike doesn't continue to fall between now and earnings. I think it has earnings end of the week. It has earnings at June 24th. So it has earnings. It has earnings on Thursday. So right before, 1 day before expiry. So that's perfect. So maybe I'll just place the trade before expiry, so on June 24th, or maybe I'll do it on Monday. I'm not sure. But it has dropped a lot in the past. Look at this. In the past 5 days, it went from 130 to 128. So at some point, it was at 127. So it could be a good entry. The day's range actually is 126.91. So on Friday, June 18, it was trading on 126.91. So I don't know. Maybe it could be a good entry to place it now before earnings. It doesn't have high implied volatility, but it has earnings. It dropped. It's been in a downtrend. Maybe it'll boost up after earnings. Who knows? Maybe it continues down. But given the fact that it had a 52-week high of 148 almost, and you'd be selling a put at 122, you could be, I could be a little bit, I'm not too worried if I have to roll it, for example. So this is a potential trade. I'll see. I think another one is FedEx. FedEx, I would not do a put spread on FedEx. It's too high. If it gets breached to the downside, then it would be hard to manage. It would be too expensive to roll. But maybe a put spread. I might do a put spread on FedEx for June 25th expiry. So let's look at the option chain. Actually, just out of curiosity. So we could see that the straddle 285. So the straddle is 8 or 9. And then plus the 285 is 8. So it's about 8 it's about 18, let's say $18. The expected move is about $18. So if we sell something below 285 minus 18 is about 267. So where's the put at 267? Yeah, if you do a naked put, let's say at 265, you'd get $2. If you do a put spread maybe of 265, 260, you're not gonna get $1. If you do 260, if you do 270, 265 put spread, yeah, you could get $1. So the 270, 265 put spread gets you $1, but then you're 15 points away from the current market price. Or you could do a naked put. Let's say you go to $1, wherever you can collect $1. You could go to the 260 strike, sell a naked put there. I'm not sure yet. I would probably do a put spread just because I think naked is too expensive for me. Naked would take about 0.3 times 260, let's say. Yeah, it would take about 7,800 maintenance excess. If it goes up, it's great, but I don't know if it goes up or down. I have to assume that it can go down, and I have to be able to afford rolling it if it goes down, like I'm rolling the Pinterest or Spotify or Twitter. And I also have to, if I look at the chart, I mean, is it at all-time highs 1 month? Yeah, it's not at all-time highs. It kind of looks like the Nike chart, actually. I don't know, maybe a naked put would be a good idea. Another thing to do is you could look at UPS to compare what UPS did after earnings. So usually I think right now shipping is doing great because everything's from home. Yeah, so I don't know. So yeah, so that's a potential trade for next week. We'll see. All right, so if you have any questions, leave in the comments section below. Like always, if you want to join the Trade Alerts group, link is in the description below. It's $25 a month. And you get my trades as soon as I place them via WhatsApp. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.